Good morning, everyone. Thank you for joining our webinar. I'm Maurizio Malvasi from the sales team here in ENG Invest. With me today, Filippo Lanza, founder and portfolio manager of Numen Credit Fund, and Alessandro Barison, portfolio manager of Numen Credit. We are in a particularly dynamic macroeconomic environment, as you may know. So we thought it would be a perfect moment to have an update webinar today with Filippo and Alessandro. So the floor is yours, guys.
Thank you, Maurizio, and good morning to everybody. The main focus, obviously, of the markets is all about Trump and the macroeconomic policies that have been presented and implemented in the US, and obviously the reaction function to that in many other macro blocks. First and foremost, I would say Europe as of now. Obviously, during the first Trump term, there was a talk about the Trump put on the S&P. Then I think that morphed into more like kind of a desire of the administration to keep the yield low in the 10-year US Treasury market. And most recently, there's been a lot of talk about the so-called Mar-a-Lago Accord, as opposed to the Plaza Accord. The outline of that is pretty much a weakening on the dollar to allow reshoring, reactivation of the US economy, possibly even a debt restructuring. Obviously, the vast majority of the US debt is held outside, and that's where the strong dollar so far has benefited incredibly the US in terms of refinancing. And then obviously another pillar of that policy is the policy adjustment via tariffs, regulation, a restriction, and so on and so forth. And then ultimately the sovereign wealth fund creation, possibly moving from real estate assets all the way to cryptocurrency, forming a digital reserves. There's been a lot of talk about that. We don't know exactly how much of that is going to be actively implemented. But one thing which we can say with confidence, as opposed to the first term of Trump, is that on one side, the cabinet and the infrastructure behind the administration is very, very professional. Very robust. Just thinking about the Treasury Secretary, Elon Musk as a consultant in terms of efficiency. So it's a very formidable organization with plenty of resources. So they can definitely do some of that. And because of Besson's presence on the Treasury, some of these points are definitely relevant and should be kept in mind when building the portfolios. The second point, which is obviously a negative, is when Trump, which is the difference between the first term and this term for Trump. The administration, the first term, had a lot of things going in their favor. Taxation was high, could be cut, deficit was much more contained, monetary policy could be supportive. Obviously, we're in a very, very different scenario now. Deficit has been exploding, predominantly due to COVID, both under Trump and under Biden. And then, obviously, secondly, the tax cuts need to be maintained rather than improved. So the risk is that automatically those tax cuts will be removed unless Congress take action. So a very different kind of macro climate, a lot of uncertainty in terms of policy. I will move to the next slide, and I think that exemplifies the big question mark. Obviously, here there's been an enormous amount of correlation and co-movement, if you want, between the US and Europe. Not just economically, financially, in terms of trade, in politically, from an ideological point of view. The big question now is that over? Are we going to have a proper kind of decoupling, either in terms of policy, relationship, military alliances, and so on, which then opens the conversation, which we're trying to summarize on the next topic, about secular trends and Trump counter trends. Obviously, there's a lot of talk about Trump and his relatively idiosyncratic personality as the driver of what's going on. A couple of things to keep in mind. On one side, Trump is not here forever. We doubt it's going to be a constitutional change, so he's here for this term, and he's going to be very much sensitive to what's happening during the midterm election, which is probably a couple of years away from now. At the same time, Trump is in a trend of administration which have been relatively consistent, and I think some of that has been dictated by a big change in the energetic balance of power, balance of power that has changed massively over the last couple of decades in America. US moved from being a massive importer of energy products to be the biggest producer on Earth, and then one of the biggest exporters as well. So that obviously changed their approach. They're obviously much more inclined to be isolationist and focus on their own economy, especially if in their idea they want to expand. A few decades ago, you would have talked about trade agreement or trade area. Now they're talking about transforming Canada and Greenland as new states, but nonetheless, clearly his focus is within America. So secular trend, Trump counter trends. Obviously, there was a big secular trends, which was ESG, which was quite prominent over the last 5, 6, 7 years. We can, safely assume that S&G will not be that relevant, but we think E as an environment, as energy supply, as reliable energy supply is still going to be there. And I think, Europe has been paying a massive price for relying predominantly on Russia gas exports and imports, so we think that's going to be here to stay, the E of energy, and also because of climate change. We think climate change will be very challenging and very stressful from an economic financial point of view, and that would have implications. So great opportunities in that sector, which has been quite damaged since the election. The second point, we spoke about it already in terms of globalization. We know and we expect more kind of trade battles. The problem with trade tariffs is because they can be literally escalated very quickly at the stroke of a pen, but they can have very, very large implication. Obviously, the risk is that there is too much uncertainty, and then it becomes a proper shock on the economy and growth, not just in the rest of the world, but US itself. And then obviously there is the other risk of creating implicit adjustment mechanisms. So you can have like a matching escalation, which then would create, in our view, potentially could be mini black swan, or could be like a proper funding crisis in the world. And so obviously we need to monitor that very, very carefully. As we've seen, obviously, tariffs can actually be remodulated, renegotiated, withdrawn, and change very quickly. So that source of volatility is definitely here to stay. But then again, is not much a Trump trend, is something that, we've seen even with the Biden administration, and even before Trump, there was already a movement because of the independence of the US economy and the technological advantage of reshoring. The other big trend obviously is AI. We think AI is going to keep on going as a trend. We think it's going to be massive capex, massive energy consumption, but and a very defined, widespread kind of application and adoption of those technologies. We do expect an enormous amount of regulation and specific tariffs and intervention from the state, especially in US, that obviously would have repercussion, especially on the S&P and the Nasdaq, given the relevancies of the Magnificent Seven, and the technological sector. We think over the next 6-9 months, we'll see a lot of the AI capex coming to fruition through real economy and companies, especially new companies and startups, and that we would expect that to have a very profound impact on productivity and consequently this amount of deflation coming up. The last point is the tax superiority and exceptionalism. Again, Europe used to be, and China very much behind the USA. Obviously, as we noticed with DeepSeek, but we also noticed with other system and model like Anthropic in Europe, the barriers to entry are actually much lower when it comes down to LLM and their application, their training. And we think technological advancements there actually will bring down those barriers even more. So then the kind of monopoly effect and monopoly status of US technology could actually be very different from what we're seeing with, for example, the internet, or rather than the operation systems like Microsoft or the cloud with Amazon. We think in this case, those kind of sectors would be much more distributed geographically. I think we've seen plenty of LLM coming from Asia, from China. We'll see more. We'll see probably some in Europe. And I think as if you want OpenAI train their system on the free internet, there may be other models that will train on OpenAI or the existing LLMs. So that is creating a bit of an arms race, which we think will be, by and large, very deflationary. If we move on the specific in terms of the military alliance kind of side of things, we think we're moving from Cold War to a dominance of the US as the only superpower, and now we're going to a pretty fractured and chaotic multipolar war. We think the most important set of events now is regarding Germany. Germany needs to decide with the existing parliament to remove the debt brake because they could get to the majority. It's very unlikely they would be able to achieve the same majority in the next parliament. That basically set a very tight deadline of the 24th, 25th of March, which is when the new parliament comes. And so working backwards, there is a certain amount of votes that will happen in Bundestag and Bundesrat. And that will be very, very important because we think that is a bit of a Rubicon now for Europe. And that would change massively, moving from kind of an austerity, constitutional enforceable in Germany to like a proper kind of, fiscal expansion. Obviously, because of that, we think it's a big opportunity to belong Europe in general, because Europe will move to like a pretty serious kind of state-driven consumption and investment cycle. Obviously, Ukraine is another positive, and at the same time another set of demand in terms of reconstruction if we have a ceasefire and a resolution there. Moving forward from that, if Europe is really pushing with Germany leading the way, and then eventually moving more into more of a fiscal union, more of a kind of, majority-driven decision-making, and then possibly implementing some of the Draghi plan, we think that would have a repercussion all the way through. One perfect example for us is the antitrust legislation, which we think is excessively and irrationally restrictive in Europe across many, many sectors. We think we should be seeing a lot of like cross-border merger, whether it's banks or telecom, but also deregulation. And that's why we position in some of those sectors. ECB, we think, is an area of strength for Europe right now. We think ECB has learned the hard way how to become flexible and innovative and all that. And we think that will be a driver going forward. With ECB effectively supporting this fiscal expansion, not fighting it in any way, especially if it's coming from the core, i.e. Germany and France. One big driver also for us in terms of asset allocation and in terms of opportunity remains the multipolar world. There's plenty of countries we've been involved in a successful way, Argentina, Brazil, even UK and Turkey. There will be a lot of attraction and ability of Europe, in our view, to kind of redefine the relationship with the countries around them, especially in this kind of rearming race that has been effectively triggered by Trump request to increase the NATO, by what we've seen with Ukraine, where Starlink could literally switch off the system, and similarly for the maintenance and software management of some of the weaponry equipment that was provided to Ukraine. So we think, in a nutshell, next 10 days will be very, very important, very consequential, and we are monitoring them very closely. Overall, if we need to summarize, and then I'll move to the next slide. What is the asset allocation? Well, obviously we're very careful, very attentive to what's going on, but we attach more than 2/3 probability that Germany will pass the debt brake removal for defense spending, and they would also approve the infrastructure spending. We also think that if that happens, kind of in a conditional kind of way, Europe will follow through, France, Italy, and all the rest, and ECB will be supporting. With that in mind, we then think this could be a big investment cycle and consumption cycle starting in Europe, which will basically change completely the parameters around the yield structure in Europe. The spread, we think, will be compressed still, but the yield would move up with obvious implication on credit and equity as well. But equity will be very much invested, and I think we also would see a big repricing of euro as a reserve currency and also as a kind of carry currency. So we think it will be like a big era for Europe. Strong Europe, weak fixed income, relatively strong equity in some sector, not in all of them. And then credit obviously mixed depending on the sector and depending on duration. Moving forward on the calendar, we think this big kind of Trump reaction cycle will probably last for quite some time, obviously in Europe. But I think in terms of pricing of the market will be priced probably fully by the end of the summer, end of the year. And in that kind of period, but at the same time, we're very strongly minded that all the AI capex that's been effectively built over the last 12 months, and it will continue to do so for the next 12 months, eventually will start coming to fruition, and that would will remove a lot of barriers to entry, will create a lot of competition naturally on many sectors, but also in summary will improve productivity and probably support GDP, but also create lots and lots of deflation, probably a much bigger deflationary wave than what we've seen with COVID, but probably more kind of gradual and spread out. And so that's in a way our sort of outlook to kind of support our allocation. So overall, very positive on Europe, conditional on whatever happening with Germany now, and then quite negative on fixed income, positive on a few equity sector and credit, but mindful on potential black swan liquidity crisis. And then over time, medium long term, very focused on AI implication on the deflationary side. And that's obviously assuming that the geopolitical context will not deteriorate further, but if anything, will be kind of contained at the status quo, if not improved. And by that, I think we don't see an escalation of Middle East hostilities with Iran. If anything, some sort of, kind of status quo / renegotiation. And then hopefully we see a ceasefire resolution of the Russia-Ukraine conflict and that reconstruction of that country. So that overall is our kind of macro view. Obviously, we're very opportunistic and very cautious. We expressed that in many ways. One good play was obviously a call option on the euro. We still think there's a lot of space there. We also had a few equity position and credit position in some sector kind of related to defense in Europe. We also had a few edges in things like, for example, Tesla, which we think was the quintessential irrational exuberance manifestation of the Trump 2.0. And then obviously on fixed income, we're kind of opportunistic and trying to see what's happening in the next 10 days. But overall, this is the way we look at the world right now. Obviously, we have plenty of trigger and red flags just to change our picture and our positions if we're wrong. I now would like to introduce Alessandro Barizon, who's a senior portfolio manager at Numen, and he runs the book alongside me. and he will walk you through a few slides on few specific stories and capital structure we involve through the fund. Thank you.
Thank you, Filippo. I will just interrupt you for a couple of seconds just to let you know that we got a couple of questions from the audience, and I will go for them. So the first one is a few hours ago is the news of European countermeasures of 26 billion euros in response to the additional US tariffs announced yesterday. So do you see an eventual escalation between EU and US, and what kind of consequences does this have for Europe's growth and the euro? On the other side, the second and last question is, are you positive on European banks, and can you give us some names of those that you are currently most interested you?
Yeah, I think on in terms of the escalation, thank you. I think in terms of the escalation, I think that's the biggest risk is that obviously Trump is very focused on the tariffs, and part of that is because he needs that sort of projected revenue to support the budget projection, and then with that support the tax cuts that they want the Congress to pass. So the problem with the escalation now is that, they're all kind of prepared. So Europe was prepared, Canada was prepared, China was prepared. Obviously, the biggest risk is a fast escalation. One thing is tariff, counter tariff, and then let's sit down around the table and, take a few weeks, months, and so the market can kind of adjust, digest, see the rumors and the news about it. One other thing is to create like automatic mechanism. So basically, you kind of match the other guy tariff every time, and obviously that escalation very quickly go to like a very irrational level, and that to us is one of the possible black swan that could develop in the market. I like to think that that's not going to be the case, but things could get out of control, because when it comes down to tariff, is literally a one-man decision, especially in the States. The rest of the country is a little bit more complicated, but still relatively quick decision making. So they're not the usual, check and balances. So that is definitely something that I would be very mindful, and that's something that we monitor very attentively. In terms of financial sectors, obviously we like it, and we've been exposed, both bonds and equity. I think there is a lot positive if the kind of German plan goes ahead. I think rates will stay up, and that would probably support the banks. I think consolidation will probably happen. That would support the banks. In terms of sector, I mean, I think obviously there's different name for different plays. If you do expect more M&A, obviously it's the smaller banks that could benefit. Obviously there's a few M&A transaction kind of out there in the market. Whether they close or not, we'll see. But I think overall, what we are a little bit mindful on the credit, obviously, is the duration of some of those instruments, because the credit quality is definitely much better. But at the end of the day, those instruments, which we all learn how to play in the last 10 years of very low rates, all of a sudden could exhibit like a very substantial amount of interest rate volatility. And most of these instruments, especially 81 and so on, they're very much short interest rate volatility via embedded options. So that is one thing where we're very careful, because if the bonds start moving up in terms of yield, eventually you will have a repricing of that too, because lots of demand that went into the sector went there because they needed to get some extra yield. There's plenty of extra yield right now in very liquid, very zero bid offer kind of security. So that's something to keep in mind. On the equity, we kind of like it. Obviously, the one thing with banks, they benefit from interest rate. In Europe, there'll be a lot of investment capital and all that. There is a risk, obviously, with tariff and all the rest, that the global picture deteriorates and there's a bit of a slowdown. So the short-term rates start going down, and then they kind of suffer. So in a nutshell, we like the bank sector, we like the finance sector. There's plenty of opportunity, but maybe the best days are past us. Ale, if you want to continue.
Hi, yes, good morning, everyone. Thank you for the introduction. Yes, I just want to run through quickly through some names and themes that we are monitoring or where we have exposure to on top of the macro part of the portfolio. The first one is actually on AI and data centers, which has been clearly negatively impacted by recent market events. The company is called Nibius Group, is a spin-off of the non-Russian assets of Yandex Group, which is the Russian Google. The company has around 2.5 billion cash, plus around 900 million invested already in data centers in Europe, versus a market cap which is now around 6 billion. The sum of the parts of the business has offered potential strong upside to where the stock is trading now, which goes from 100% to 400% or even more, really depending on the execution and the financing available, and clearly computing demand for data centers across the globe, which we think is going to stay strong despite the recent negative sentiment. So just simply valuing the company on basic assumption on a DCF basis, the AI data center business of the group could be worth between 10 and 15 billion. Now the number of employees and machine learning and tech cloud experts that the company has is around 900, 850, which is similar to what CoreWeave has. So it's just a matter of time and funding, but the company could get to the same size that CoreWeave, that is mulling that is trying to execute an IPO at around 35 billion valuation in the near term. So the upside could be that level of valuation if the company execute well, and we think they will. They have a very experienced team. They were running a massive infrastructure. The Yandex was actually created before Google. So they know a thing or two about cloud and data center deployment, and we are pretty positive on what the team can achieve. This is just one part of the equation. Then the company also has 100% of a business which is called AV Ride. Is an autonomous car and delivery robots business. They have robots, delivery robots operating in Japan already, and in Texas, in other parts of the US, and they also in partnership with Uber, and they are also planning to start testing autonomous cars with Uber in the next few months. And they're already testing cars in Korea on the road, driverless, like fully autonomous. If you look at some peers valuation, value of this business, if properly funded, maybe with a strong partner, and it can be very well be Uber eventually, the business could be worth between 5 or 40 billion if you take Waymo as a comparable. Now that's a bit ambitious, but the expertise is there, the technology is there. It's just a matter of funding and execution. Then the third main business they have is a stake on ClickHouse, 28% stake on ClickHouse. ClickHouse is a very popular high performance column oriented database. They sold the stake to outside investor in 2021 at a valuation of around 2 billion, which means that their stake is worth now. Was worth 560, but in the meantime, the database has expanded, the number of users went up drastically, so probably the valuation of these assets, in case they will want to monetize it at some point, is probably going to be much higher. And then they have other few small businesses, but overall, versus the market cap, which is currently now around 6 billion, the business could be worth five or six times that over time. So that we think is an interesting, despite the current negative sentiment, we think is an interesting company to monitor. Clearly very, very volatile. Then if we go on to the next slide, Another name which we've been involved for years now is Fiji Cairo. Fiji Cairo is a global aerospace supplier of metallic parts, mainly titanium, aluminium, which is covering pretty much all major parts of the structure of a plane, including the fuselage, the engines, the wings. And main customer is Airbus, but they also have strong business relationship with Boeing, Safran, and they pretty much in all major aerospace programs like the Airbus 320, Airbus 350, and so on. The backlog that the company has covers probably around 10 years of revenues. And the supply chain of the aerospace business is pretty much fully booked for the next 10 years, which is mainly still replacement demand and the backlog which comes before COVID. Like demand for new plane is probably gonna be like if you order new planes now, it's probably gonna be for delivery in 2030 or after. So there is strong visibility on what is the revenue and the business, and clearly the pricing power is going up. The company has just announced an upgrade on the free cash flow guidance at the end of their business plan, and mainly driven by new orders, but also clearly better pricing. And we think with the competition also from the military sector for the European aerospace supply chain, the pricing power of these suppliers and companies will probably go even higher. And so we bought the convertible at 60 in 2022 after the market sell-off. We sold most of them around par recently, and the remaining part we are thinking of converting into shares and continuing to keep like a structural small exposure to this story, which we think could benefit from many trends that are evolving in Europe in the next few years. Then if we go to the next slide, another name we are monitoring and we have some investments is AMS Osram, which is a light and sensor solution serving the auto, medical, industrial, and phone sectors. They do LiDAR, sensors, lights. Like they have a increasing and strong exposure to Chinese manufacturer, which provides some protection, especially for the auto sector, for all the competitive trends that are like happening, especially in the recent quarters. So one of the main clients is, for example, BYD, which we think is a good exposure to have in a very competitive market and with everything that is going through the auto sector supply chain. So the company is exposed to Europe, Asia, cyclical trends, and is expected to generate around 100 million of free cash flow next year in a cyclical downturn market. The stock is trading at around 6 times that amount, probably more at the moment. But the free cash flow could potentially double or triple in a market recovery if we have a strong cyclical recovery in Europe and China. So the equity offers a very cheap option on these trends, while the bonds trading at around 9.2% yield offer nice exposure to a strong deleveraging story. And we have we have exposure mainly on the bonds, but we also have a small exposure on the equity just as an option play. Then if we go on the next slide, a name that we have been monitoring and been involved for a long time is Telecom Italia, which has been very volatile in the last few years. But the company has executed well. They managed to complete a monumental transaction, which was the sale of the network, which brought the capital structure to a more sustainable level. The company is expected to generate around 50% of the market cap in free cash flow to equity in the next 3 years. And this is probably already a reason for the stock to be an attractive investment. But on top of that, we think there is going to be definitely consolidation in the sector. And now that Poste acquired the CDP stake, there's been a bit of a negative sentiment on that. But we think Poste is aligned on the target that, the target to have consolidation in the sector and emerge with Iliad, we think is not mutually exclusive after the post acquisition of the CP stake in the company. So that's a potential source of upside on top of the potential earnout that might come from the FiberCop Open Fiber merge, which is probably a very low probability of happening, at least not in its entirety, but could be a further source of very strong upside. And then finally, maybe this is a more medium-term trend, but Brazilian assets have been clearly hit very hard recently due to political uncertainty and volatility. But over time, especially probably, maybe we'll see it in 2026, going into the election with the political spectrum kind of turning a bit on the right, and could be a positive catalyst for Brazilian assets and provide a further source of upside for Telecom Italia stock. So, and then moving on, I just want to mention a couple of additional more than investment themes, more than specific positions that we're monitoring, which were already mentioned by Filippo in the initial part of the presentation, which is clearly the defense sector, how much is priced in, how much is already in consensus. So clearly, the sector has priced in a lot of good news, and consensus has adjusted to a much higher level of expectation. But if we look at what could be the upside, if all the recent programs and investment plans will actually be implemented, we could see around 100% increase on the European side of the business for all these suppliers, because we think most of the defense spending will happen through European suppliers, at least where possible. Clearly, what happened on Starlink, and Filippo was mentioning, or other action from the US administration kind of degraded the reliability of US as a partner on the military side. So we think most of that spending will go to European supplier. And while some names like Rheinmetall could be already pricing most of this upside, there are other names which are mentioned here, but also smaller suppliers, smaller players where maybe the upside is not fully priced in. So it's a sector we're monitoring where we have small positions here and there, and we are planning potentially to add over time if we have a better entry point on the pricing side. And then finally, next slide, final slide on some thoughts on what could be the new normal for European fixed income. So if we put together all the fiscal expansion that has been announced after the Munich Security Conference, we could probably get to 1.3 trillion if we include the latest Italian proposal on the leveraged guaranteed fund. We're probably going to get even higher than that. That represents around 10% of European government debt. And if we apply for discussion purposes around 5 average duration, that equates to around 200 bips of correction on European yields. And we probably only witnessed 25% of that. Now, it's not going to go on a straight line. There are, of course, a lot of other drivers, not only European drivers, which can potentially, of course, create drivers on the opposite side of the movement. But just to give a kind of a sense of what could be the ranges on European fixed income in the next 1 to 3 years. And if we look at an historical example, when there were expectations from the end of 2013, beginning of 2014, when expectation on the ECB QE were starting to build, and it was actually then eventually announced and started in 2014, the bond rallied around 180 bips from the top, reached ahead of that period of time. And eventually the ECB at the end of 2016 would have purchased around 1.5 trillion of negative supply taken off the market by the ECB. Now we're talking about this more or less the same size, but with an opposite sign. So that could be broadly the range that we could expect. That will actually need to drive portfolio allocations and strategic allocations in the next 1 to 3 years. We think that we will take into account. And then that's all from my side. Now, if you have any question, happy to answer.
Thanks, Alessandro. We have one last question before the end of the webinar. So it's about the dollar, so euro dollar. The question says, could you please elaborate more on the euro dollar reason for the euro strength and also your target and timing?
Filippo, do you want to answer that, or should I?
Oh yeah. Please go ahead, Alessandro. Yeah.
So we think, for many reasons, the euro dollar could reach maybe 1.25 target by year end. We have call options with a strike which is lower than that, but just to give a sense of the range. On one side, we have an administration which is trying kind of cutting cost and slowing the economy. At least what we are witnessing so far, the actions from the Trump administration are not exactly bullish for the US economy so far. Well, on the other side, yes, there might be tariff, there might be noise, there might be trade tension, but 2% GDP of fiscal expansion in Germany, and probably something similar that will also happen in the rest of the European Union, will probably more than offset the negative impact from tariff. So if we look at futures positioning, if we look at positioning in general on European assets, and the potential upside in European yields that would define the European the euro as more as a carry currency potentially at some point, or at least less negative carry compared to other currency, we could see a strong repatriation of savings from Europeans invested in US, or in general on European fixed income and European equities, which trades at 30 to 50% discount. They are 1/5 of the market cap of US equities. So there are so many potential drivers that these events that happened since, the last month, and very key to monitor in the next couple of weeks, could unleash on what is the level of the euro dollar. So, we say 1.25, then it can be more, it can be less, but definitely there is upside on the euro, we think.
Okay, great. Thank you, Filippo. Thank you, Alessandro. Thank you to everyone. And that's all for today.
Thank you. Bye.
Thank you, Maurizio. Thanks, everybody. Thanks. Bye-bye.